Many business owners, at best, are working with financial information that's months old, and it tells them nothing that they can really act on to forecast, to buy new equipment, to hire new staff, just to generally avoid cash flow crunches. So I sat down with Brennan de Raad. He's the president of Vessel Advisors. He's a fractional CFO, and he leads a team of fractional CFOs. I've been referring clients to him for years, usually when they're scaling faster than their reporting can keep up, or they're just getting ready to sell and they want to make everything clean. In this conversation, Brennan's going to walk us through the numbers that he believes business owners should be watching. These include things like cash flow and gross margin, which you'd expect, but it also includes things you might not expect, like customer leads or the cost of acquisition of a customer, the lifetime value of a customer, employee turnover, and customer churn. Really core metrics that help you understand how your business is actually operating. He's going to explain why every one of those beats the typical ratios that your accountant may have handed you, assuming you're even getting those. And he'll help you understand what financial reports you should be getting, as well as how fast or how frequently you should be receiving them. So, if your taxes from last year are your main source of financial information, this video is for you. All right, so Brennan, I'm super glad that you're here. Brennan de Raad is the president of, is the president the title?
Yeah, president, CEO, all the things. Yeah.
President title of Vessel Advisors, a fractional CFO, and now an executive search company, if I have that all correct. Brennan and his company, I've referred many of my clients to him and them over the years as they're scaling, as they're getting ready to exit, and they just do really important work. And so I wanted to get him on the podcast so that I wanted to get him on this interview so I could ask him some of the questions that I frequently have conversations with my clients, but I'm not an expert on all of the financials, and so I wanted to talk to someone who was. So the big question right now is I often recommend or advise to my clients who are feeling overwhelmed. They want to scale, but they feel like the numbers are moving faster than they are, and they're losing track of what's going on, or they want to exit. They're not really sure how to prepare for that. And I tell them that having your taxes from last year is not good enough information to exit well with. And so they've never had monthly financials. Maybe they've been operating for 50 years somehow. And but it happens, and they often don't know what financial metrics they should track, and so they don't know where to even begin the conversation. And so there's different industry-specific metrics for sure, and each owner might have their own numbers they want to track. But at a core, what are the basic, would you say 5 to 8 or so basic dials that they should be watching to make sure that their business is operating the way it should be?
Yeah, great question. And the frame I hear in that is, hey, I just don't know what I don't know about this. I just need someone to come in and kind of help and guide. And we love having that conversation. So yeah, from a numbers perspective, there's, again, a lot of things you could look at. One I would start on always is their cash flow, right? Cash is king. The CFO's main job is to ensure that cash continues to move in and out of the business and that you continue to have it, right? It's the way that if a company's going to fail, it's going to be lack of cash flow. And you want to understand as a business owner the actual movement of money, and not just what do we have left at the end of the month, what do we have left at the end of the week, can we make payroll? We want to have a view into the future. So the first really big number is a 13-week cash flow forecast. Yeah. And it's a pretty simple thing to set up, and we do it all the time for clients. But that's number one, is you want to look out in the future. You want to reduce surprises. You want to really just be able to say, can I pay the bills each week? And most months, or even if you have annual seasonality, you're going to see some dips, right? You're going to see areas where, hey, the third week of every month or the fifth, if we have a long month, like it's going to be a bigger cash crunch. You see that 90 days out. You know it. Right. You can plan for it just like you would on any other kind of project, and it takes away that anxiety. So that's the first one, for sure.
Good. And that probably also helps if people are trying to make hiring decisions or capital investments where they can start to figure out, probably not now because we're anticipating a 3-week dip. Maybe we should do that after we start to get some of our receivables in or something like that.
Exactly. Yep. Yeah, you can use it for a lot of different decision making, and hopefully aligning that to a budget that says, are we within the range of what we expected, or are we above or below? Yeah. And that also can help you dictate that. Because if you're growing quickly, that looks great on the top line, but it's probably using more cash to generate that if it wasn't in your budget.
So let me ask a question around that. Sorry
Yeah.
for interrupting, but oftentimes when I see a statement of cash flows, I find that it's difficult to read. It's hard to understand,
Yeah.
and it's not written out in a way where I can actually look at it and visually see what's going to happen financially.
In and
It
out.
seems to
Yep.
require some kind of financial interpretation. Can you explain that if my accountant sends me a statement of cash flows and they say, here it is, you want it, you asked for it, you got it, and I got this one-page document that I can't understand, why don't I understand it, and should I be asking for something different?
Yeah, great question. I would say it's arguably the most important statement. It's also probably the least reviewed and looked at by any business owner for the exact same reason you just said. So the 13-week that I'm recommending for cash flow is different than your statement of cash flows, just to be clear. The 13-week is a looking forward. It's an estimate or guesstimate, probably at best. Your fixed costs that you kind of know, your variable costs that you're guessing on, and then the timing of, is it going to be this week or next week? We're estimating there. The statement of cash flows is a fixed period of time of what actually happened. So you're looking back. It's a lag measure, and you have different type of activities that are listed in there. The best way that I've seen the statement of cash flows presented is actually not in the PDF that you probably get or the file you get. It's actually like a bar chart that shows the inflows and outflows, and so we provide that for clients where it's like here's the report that actually makes sense. But what you want to look at there is your beginning cash balance, your ending cash balance, right? And some people go, oh, it's positive, but if you drew $250,000 on your line of credit, you need to take that into account, and that's under there's a financing activity, there's an investing activity, right? If you chose to buy a piece of equipment and not and to pay cash for it, right, that would be an investing activity. And then there's just the normal operating activities of the business where you have different things swinging. So I would agree that statement is a challenge. Yeah, it is a challenge.
So when most owners and executives are wanting to track cash flows, I believe most of them are looking for insight into the future. And they're trying to figure out how to pace spending decisions frequently. And they should be asking for a 13-week forecast or a 13-week statement of cash flow,
Yes.
not the statement of cash flows on its own.
Correct.
Okay, right.
Yep, and this would be something that would just get updated once a week, as information changes, right? We didn't pay this week; it's going to roll into the next week, or we paid something early. We're gonna project to pay something early. We're going to change that on my statement.
Great, super helpful, super helpful. So what else? What's something else they should be tracking?
So another one that I put down was gross profit margin, and this is just the percentage that you keep, the money that you keep when you're delivering a product or service. After you've completed that. It doesn't include rent. It doesn't include marketing costs or sales costs, accounting costs, other operating expenses of the business. It's directly related to that project, that deal. And I think, taking construction as an example, it's easy to know I've got labor, right? I've got materials. I might have some other miscellaneous costs, insurance directly associated with the job. These are all things that I wouldn't have if I didn't have that work. So it's directly allocated to that job. We want to know what that percentage is or that margin is. Simple example, I think we've referenced, if you had a $10 million project and you have $6 million in expenses, right? Your gross profit margin, right, on that would be the 40, would be 40%. And so that'd be a nice number. That'd be a great number. Not usually that high, but just conceptually.
Some of my electrical contracting clients have gotten in that direction.
Mm-hmm. Yeah, it's market to market, but
Yeah.
you want to know that number, and there's a macro view of that, which is all my projects in total. But you really also want to know that monthly for every project. So someone within your organization should be responsible for checking that, and it's important, right? Because you're estimating, you're bidding, and you're estimating in that industry example, and then the reality hits, right? It's like, well, the guy got sick, or we didn't have a full crew, or the efficiency wasn't there, and so there's reasons why maybe a margin might be estimated at 40 and it comes in closer to 32,
Right.
35. And if you're building the rest of the costs in your business and how much profit you want to keep, like your bottom line, whether that's some clients will say net income, they'll have net operating income, they'll have EBITDA, they'll have EBIT. There's different ways of looking at that.
Yeah, so many different ways to define profit.
Like what do you keep? Like what are you taking home, or what's the cash? What are you keeping net of accounting entries that are in there. So what I would say is gross profit margin should absolutely be looked at a macro level, but if you had the ability to do that at the project level, at a job level, that's really what you want to do, and compare it to what you estimated. So you're moving that along and informing the whole system.
Or line of service or project. I mean, you could divide it up in any of those ways.
Absolutely.
And I like that because I find that many clients have pet projects or they have something that they love providing or is very easy to sell. And it turns out that it's actually costing them money or at best break even.
Correct.
And it's not actually profitable for them to provide it. It's just something people like. And that helps them recognize that if they're trying to figure out why can't I ever gain traction? We're selling stuff left or right.
Yeah, and I think it answers the question like, am I pricing my product or service correctly? Even though you have this whole pricing methodology and how it's working, by watching that actual margin, not what I think it's going to be, on a monthly basis, or ideally at a project or a job basis, it's there. This happens quite a bit, and I think you run into things like right now, the cost of fuel, right, or the cost of just certain component parts that are rapidly changing, depending on how your contracts are set up. That might be something very easy that you can pass along or that you can bill for. In other cases, you're absorbing that, right? Because you book something out 2 years out and the price is the price, fixed bid. Those are really important things to get ahead of and think about. So it's not that you're going to fix that job right now. You're going to have to deal with that situation, but it might inform how you estimate and price or terms that you care about more in contracts about, hey, you do need to lock in a material cost within 30 days of signing this bid, or the price floats, right? And during COVID, we saw a lot of that. Even recently, actually, where it's kind of some of this is coming back with labor and tariff.
With the tariffs and stuff, yeah.
Yep, absolutely.
All right, so cash flows and gross profit margins. What else would you track?
The other one that I put down, kind of shifting more to lead metrics and more on the sales side, would be leads. So this could be broken down as simply as all leads that come in, or it could be a subset of leads. It could also be a stage in your sales process, maybe from the time the top of the funnel when someone comes in all the way down to a proposal sent. And what we're trying to do there is we're trying on a weekly basis to say, are we generating enough activity that's going to keep driving the budget? Either if it's flat for the year, that's fine, but we know what that lead number needs to be. If we need to grow the business, right, we probably need to be increasing lead volume, in proportion, maybe even a little more aggressively.
Yeah.
And so that's a really important one for the finance team, because we want to look ahead and go, okay, if we're selling a lot right now on the positive end, that's going to require more labor, more material, more cost, more cash, right, that needs to come in. Do we have it? Do we need to go get it? It's much easier to go to a bank 90 days out from when you need something, or even 30, 60 days out, have that conversation, show them the story, versus 2 weeks before, or having to say no to a project, which does happen, right? You just don't have the cash flow to maybe support it, or you want to grow at a rate that the business isn't able to.
So just so that I'm understanding the language or translating it, certain industries will use the language of leads, especially if they're very sales heavy. But if it's like a hospital or a clinic, it might be like new patient visits.
Yep.
If it was a construction company, it might be how many bids have they put out?
Yep. Bids, estimates, shipped, sent. Yep.
Something like that. So whatever would be the mouth of the funnel for them in terms of starting whatever their sales process is or their relationship building process with a customer of some kind.
Exactly. Yeah. It's making sure, because if you see that spigot slowing down,
yeah,
right, which sometimes like an ad is running and it's doing great, but it gets saturated in the market or online, it's a niche market. Everything looks great for 3 months, and the company starts to build on that, and then all of a sudden it drops back down to right where it was 4 months ago. We want to see that quickly within weeks to make sure that we're not waiting for the P&L at the end of the month and even end of the quarter, depending on how quickly you're closing, to know what was happening and going on there. And so again, that's a lead metric as opposed to a lagging indicator. Another really big one that I would say it's kind of adjacent to the sales side is on marketing. We have what's called customer acquisition costs, right? Or the cost of acquiring a new customer.
Right.
And this is can be a little more nebulous and harder to lock in if you're in a business where it's highly relational, right? You're not putting in marketing spend or buying billboards or paying for ads. It's more people. But even then, right?
There might be lunches and time and all of those things.
Yeah, or it's the payroll of that person, right? If the owner is doing 80% of that, then I would argue that officer's salary should actually be 80% moved into sales marketing, because that's the cost of what you're asking them to do. And so what that allows us to do, though, is start to see, okay, we closed 4 deals or 40 deals or however many deals in that month. What was the cost associated, and what's the average cost per one that came in? If you're in a business that average transaction is $100,000 or millions of dollars, right? You have a lot of flexibility there. We would generally want to keep sales and marketing costs 12.5% or lower. If you can really drive that down, that's fantastic. Do by all means do it. You'll keep more of every dollar you make.
Yeah.
But that's a kind of a rule of thumb on the budget for a lot of the industries we work in. But by looking at this and seeing it, again, doesn't have to be maybe weekly, but at least once a month. The hope is that you can see that acquisition cost and how it's moving over time. And I would say, like myself as a business owner, when I see that, I go, okay, the ratio there is usually hopefully very good, right? Let's say if you're in a service company, your average price is, let's just say for easy numbers, $100,000. Maybe you're spending $3,000 or $4,000 to acquire each customer, but the math would say from a growth perspective, you could probably spend 3 times as much as that,
right,
and continue to accelerate and grow the business. That might change your decision making, or maybe you hire that person faster,
right,
because you go, hey, I want more biz dev to come in because we have the machine to support it. We're just weak on leads. So again, it's an indicator for you to see what could be coming. And then another one that's really important, this is more of a month-end number, is I'm going to get in the weeds here and I'm going to try to simplify it. So it's they call it CAC to LTV. So your customer acquisition cost, that number we just talked about, compared to your long-term, like the value you're gonna receive from that project.
Okay.
So again, to simplify the number, let's say over the course of a 2-year engagement or 5-year engagement, you pick the time frame, it's worth $100,000 or $20,000 or $100, whatever the number is. You want to then look at what's your acquisition cost compared to that. And if you were in, like a venture capitalist, side, and you're just trying to put money into a business to grow it, they look at that number very intently, because they go, hey, I'm willing to continue to buy customers if you're telling me we get revenue for them for 3 years, and it's going to be like, this is how successful it is. It's going to be a 3-to-1 or a 4-to-1.
Yeah,
we want to do that. On the flip side, if it's costing you too much to acquire a customer, that's an indicator for you in the business of this isn't sustainable, right? We probably can't change pricing, and our cost is too high. Maybe this is an area we shouldn't be investing in, or if there's another area of the business that is successful, to your point earlier.
Yeah, or I mean, there's different ways of looking at that. If in your industry, most people have those customers for 2 years, and you've got them for a year, you can figure out the cost may be right, but not for how long we're holding them. And so you could start to identify, because when people feel like, what do we need to do? And I like what you're talking about here, because it starts to help illuminate the levers that people can pull to start to change things and performance in their business.
Yep, absolutely. Okay, so that's another one. I want to move a little bit into, you kind of see I'm bouncing between different departments within a business here, right? We have kind of maybe the sales side, the marketing side. So on the human resources or people side, one of the most important things we want you to look at is your turnover, so your ratio. And that's not like turning over a project. This is an employee. Usually the most hidden painful cost in a business is employee turnover, right? Someone who's been trained up, they probably took 3, 6, 12 months to get them in the way you do business, even if they're fantastic before that. Okay, now they're really rocking and rolling, and then 3 months later, a year later, even 2 years later, they're gone. And so you want to monitor this and set some targets. In different industries, it's very hard to keep people. Like if you're in fast casual food services, right, the ratios are wild, and that just makes sense because these are jobs that are transient. They're in and out.
Yeah, they're seasonal jobs, college students, stuff. Yeah.
Yeah, exactly. Yeah, summer, college, hospitality swings. But on the flip side of that, you also have very large organizations like like Big Four accounting firms like EY or KPMG, who they spend a lot of time training and investing, but they have a massive amount of turnover every year, just given that they've got 100,000 plus employees for each of those organizations,
right,
and it's kind of known in that industry that you have to have a pipeline and build it. And then there's others where, hey, someone comes in, they've been there for 5, 10, 15, 20 years, or the average organization's life, it's like 8 or 10 or 12 years average duration.
Yeah.
And you need to match it to your industry. So I would encourage you, that's an easy ChatGPT or Claude question to get data and research on, but align that and then compare it to how you've been doing maybe for the last year, the last 3 years.
Yeah.
You can take a data set, and it just gives you a pulse of, okay, if I have a person in HR or someone who's responsible for that, I want them to be responsible for this number, and what's acceptable in our industry. How can we maybe go from where we are to get to the acceptable range, or if we're already at the acceptable range, how can we beat it by a couple points? And we talk about ways to add value. You, just like a customer, you extend them a couple extra years.
Right. Yeah.
If you extend an employee a couple extra years or for life, it is hard to quantify that, right, in dollars, but the cost of turnover, I've seen it anywhere from 3 months to 18 months of whatever their salary was is the true cost of the business, depending on the industry.
Yeah. Usually the higher, more closer to executive level role or highly skilled technical professionals, you can get to or significantly exceed 100% of your end. This is full total cost to the company of replacing somebody, because of recruitment costs,
Yep.
opportunity costs that are lost, transition costs, all those kinds of things. That's a way of calculating it. Frontline employees, it might be, like 20% or something, but that's still a significant.
Yeah.
And I like the reason of tracking that. I always feel like the industry norms include all of the underperformers.
Yeah.
And so, my advice to my clients is, if your norm for somebody in this position is 3 years, you should be able to get at least 3.5 or 4 years just by being a decent employer.
Yeah.
And so let's work on improving that, because that norm is, it's this average. The other part of it is helping people think differently, because there's often a very binary view about turnover. Like, either we keep them forever, which nobody can, because people are going to die.
Nobody stays forever.
Yeah, nobody's going to stay forever. And really, it's more of what's a reasonable expectation. And I think that within a lot of companies, if we realize, well, within this role, 3 years is a reasonable expectation, what if around year 2, we start positioning for them for a different role, as opposed to planning for them to leave?
Exactly.
And it just creates a little more mature approach to staff planning.
Yeah, we were talking earlier about many of the clients that are looking to potentially have an exit, sell, or have some type of liquidity. When an analyst, or when a bank, or when a buyer is coming in and looking at the management team and even just the staff, this is a ratio they're going to look at. They're going to say, how do you compare?
That's huge.
And then if you can look at your leadership team and say, hey, they've been there for 3 years more than the average, in the industry, they're going to look at that and go, okay, this is a stable operating machine. That
It's one of the first questions I ask when I'm trying to evaluate a company for anything. It's like taking a pulse. It doesn't tell you everything, but if the pulse is off, then that's really something that needs to be looked at, because high turnover is a very simple, highly correlated indicator of there's a problem here. And so now you can have high longevity and also have problems, but high turnover is almost always connected to a problem.
Yep.
High for the industry. High for that industry.
Yeah, that's why I wanted to caveat that one, because someone might say, "Oh, I think we're doing great," and you need to benchmark it. You need to take a look.
Yeah,
I like that tweak though. You're right; it includes all the underperformers. So, yeah, in the middle is not high performing. One last one, just when we're talking through this, churn. So churn is a term of when you lose a client, right? So you can have what we call a logo churn, or like a company churn. So one company churn, and you can also have churn as a percentage of revenue, or so let's say you have 20 clients, but 2 of them represent 60% of your revenue, maybe 30 each. And you lose one of those, it's like, oh, we lost 1 of 20. That's not terrible on a ratio, but from a revenue perspective, right, it's massive. And so churn is a really important thing to be watching, and it ties back into that customer lifetime value, right? The more you can focus in on improving or avoiding churn, so improving the churn metric, the better. And this is not one you're going to take a look at daily or weekly, but this is once a month and even once a quarter, depending on the industry and the business size.
Okay.
You just want to have a pulse for it and see if there's some major swings, because again, it's an early indicator of folks are not happy.
And so churn would be customer turnover?
Customers that pause services, stop services. Yeah.
Okay. All right. So how do you track that if you're in, let's say, a retail business? You're running some kind of I don't know, grocery store or t-shirt shop or something like that.
Yeah, retail I'd probably focus that more in on, that's more around like the customer, like rebuy rates. So what's your percentage of after the first purchase, what percentage make a second purchase? And there's industry standards for that too. It's completely opposite of.
So you're using rewards cards coming through the checkout stand to track that?
Yeah, or email addresses or credit cards, in many cases too, depending on what tool is being used.
So you have to have some kind of tracking methodology to find out how often are they coming through.
Yeah, if you're in Shopify, if you're in WooCommerce, if you're in any of the major tools.
Okay, for like an online type business, yeah.
Yeah, but yeah, if you're in a store, yeah, you'd have to have a physical way of doing that. And candidly, the transaction sizes at that level are sometimes it's not worth it. But yeah, you why you're getting 5% or 10% off to give them the email address on your first purchase,
Yeah.
or some bigger offer is for that. But same thing in that world. In retail, it's it's an omni-channel cycle. So the churn is, I don't think I have a client actually where I do that. So maybe it's not a great one for everybody, no matter what. But generally, like in services, in manufacturing and construction, right? You have these customers that are repeat customers that come back month after month or year after year. You want to know if you have a buyer who comes in and they've come in 4 years out of the last 5, and then all of a sudden they're not placing orders and not calling you. We need to know that and understand what's going on and understand what the impact is. On the flip side, like in software, they've for a long time we had the opposite, right? Where you had expansion. So let's say you're selling a software tool and you sell 10 seats, 10 accounts. And then the next year that company comes back and says, we need the 10 and we've hired 3 more people, right? So now we need 13 and now we need 19 and now we need 25. So this expansion, that's growing in. So it's not just trying to maintain the revenue in that industry. If you didn't have expansion revenue and like 110% year over year, you were under market, right? Everyone was growing and doing that, and then things have changed and the baseline has shifted. But I think that the main thing is monitoring your customers and who's coming in and out. There's always going to be natural, companies get bought, people change, new people get hired, they don't like the tool, it's going to change. But you're trying to see what that normal is, and then again, make sure you're just like a dashboard. As soon as it pops up red, spend some time investigating it and trying to solve it.
So I'm hearing a couple of numbers that are around financial performance of the company, cash flows and gross profit. And then I'm hearing a lot of numbers that have to do with kind of ways of measuring your acquisition and retention of relationships with customers. And then a little bit of numbers about retention of employees. Is that, am I catching that accurately?
Yep. It's a spread.
So that's different than what I often hear when I talk to accountants, which is a list of ratios, which they want to give people. And so you get your dashboard and it's like, oh, I've got a 0.6 here and a 1.2 there, and I don't know what that means. Why did you not answer that way? Why didn't you give me ratios?
Yeah, so if I'm talking to because it's not useful day to day and week to week for the business to drive it forward. It might be a covenant. It might be something that the CFO needs to handle or the finance team needs to be looking at, like within their ratio, like if they have their dashboard within the department. Absolutely, especially if it's a covenant for a line of credit or something like that, you need to be monitoring that. But yeah, I mean, I love operating expense ratios. I eat them up all day. However, for a business owner, that's like you're in the weeds and it doesn't tell you enough to move the needle. Whereas everything I just gave you gives you a pulse on different departments on how things are moving. And we'll challenge leaders when we go meet with them to say, hey, if we had to measure you on one thing, what do you think that is, right? And we don't necessarily know, just being new to the organization, but if you're in marketing, right, well, you need to be delivering quality leads, ideally marketing qualified leads, to the sales team, right? If you're in the sales team, you need to be closing at a certain ratio when those leads come through. If you're the operations team, you need to keep your customers getting what they have consistently, and that they stay for a long time, or their NPS scores. Like these are the things that actually move the needle in the business. And I do find, like you're kind of alluding to, that when you put a whole bunch of ratios up on a board, candidly, business owners they just glaze over. Like, well, like what do I need to know? Tell me what I need to know. Like what decisions do I need to make? And those don't help you make short-term decisions, and definitely in the day's decisions. A lot of times when we meet with a client for the first time, I'll ask them, what are you looking at today? Like at the end of the month, like what are you looking at?
Right.
And they go, well, I get the email, it's 20 days or 30 days after the month, maybe 40 days, it's late. I look at revenue.
That's if they get one.
If they get it, but it's usually PDF, so it's like, oh, it's a project to go sit on it.
Sure.
I look at revenue. I look at the bottom line. I look at cash, maybe. Probably checking cash every day already in my bank account, and that's about it. And if it's within the kind of the thermometer range of what's normal, it's like 70 to 75 degrees or 68 to 72 degrees, depending on how you like your house. They move on. There's no additional review. We try to flip that and say, let's look at these numbers either weekly or monthly. Let's have a set call to go through it, and it's going to be more discussion based. It shouldn't be just this was up, this was down. It's like this is up, this is down. Here's why we think it is, or here's what finance has seen. What do you think? And they'll go, well, I had a meeting with that customer yesterday, and this is what's happening. Okay, it sounds like we need to have a meeting to just handle this one issue. Great, that's an action item. let's move on to the next thing. And it turns that finance conversation into, one thing I was thinking of before we were getting on today was, using financial statements as managerial tools, as opposed to it just being that email that you get once a month, or that piece of paper that drops on your desk and you look at it and hand it back and shred it. Because it should drive decision making all the time. And some of these things we're talking about are lead measures that wouldn't be on those financial statements.
Right.
But I really believe strongly in that if you can kind of classify in your brain, the financial statement is a managerial tool, just like any other tool you have, lever you have in the organization, I think it'll flip and make your business much, much better.
Yeah, I think there was only 2 of the indicators that you described that would show up on a typical financial statement. And so you would have to compile a report from your other departments or activities.
Yeah, these are manual things. It's not push button send. And I'm assuming that you're looking at your profit. I'm assuming that you're checking your cash balances. I'm assuming there's other things in there. I'm just saying what kind of bubbles up to the top where you can make decisions. Obviously, if the business isn't profitable, that's a problem. Maybe that becomes a metric for a season. But if you're in a business that's continually posting a loss, there's bigger things we have to handle.
So why didn't you say things like previous year comparisons or performance to budget, or things that are fairly common?
So those are things that we would usually handle in the actual monthly financial review meeting. So yeah, you'd have a trailing 12 months. You're looking for trends there. You're looking at prior year, prior quarter, looking at trends there. But those are more analytical exercises. Those are less of like a dashboard where I can quickly see a number that pops up. And that's part of, again, just kind of normal. A finance team should be supporting and providing that and flagging those items and saying, hey, out of the 70 accounts we have on our P&L at a budget, there's 4 that are above 10% off, and there's 4 that are maybe up or down 10% or up or down 5%, depending on what your thresholds are. These are the ones we're going to talk about today, and they're going to present those to you. That would be the right thing to do. If you're the CEO and you're having to do that yourself, what I would say is make sure whatever budget you have is in the accounting system you already are using, and have the finance team or even yourself, run that as a separate report, and it'll be called a variance analysis. It's a budget to actual variance. Yeah. It's going to give you a red light, green light for those, and if it's again 5%, 10% thresholds, that's what's going to push you over. But that's 40 days, 30 days, 20 days after that period is closed. So you're looking pretty far back at that point, versus what I'm trying to suggest here, and what we ask our clients to do is to say, forward looking, let's get ahead of the numbers. Like you should kind of know what your P&L is going to look like based on these metrics that I'm suggesting here.
Yeah, I like that.
But happy to talk to as many ratios as you want. I think the accountant speak is great, but I think part of why business owners don't invest the time in that is someone comes in and they start talking. Maybe like an attorney would speak to me about complex law or a case law or something. It's going to glaze over my head. Whereas this is we need to speak the right language to the receiver of the report.
My last question is, in terms of reports, about how often should they be getting what kinds of reports? Like on a weekly, monthly, quarterly basis? Just look at it all when you do your taxes sometime next October. Like when?
Don't do that.
But what's the frequency, and roughly what should I expect in reporting? And not just frequency, but I guess timeliness. Like, how long after finances have happened should I get reports on it?
Yeah, it's a great question. So I would say, first off, at the end of every month, you want a profit and loss, which can also be called an income statement. You want a balance sheet, and you want your statement of cash flows. That's the bare bones, what the software and what the team should be presenting to you. Industry-wise, it really depends on the timing. I would say in construction, it generally leans longer. We've come into organizations that are 3 or 4 months behind. We'll get them down to 20 days, 14 days, 22 days, somewhere in that range. They're just more dependent on other providers to provide invoicing and information that could be a little bit slower. In other industries like e-commerce and in some service firms, you can close in 3 days. You can close in 5 days, right? The data is readily available. It's being managed and processed every day. You're waiting usually at the end of the month just for maybe some end of month adjustments and payroll, or looking at something from a holistic lens. But those businesses, all the data is readily available. I would say on the average for us, it's between 10 and 20 days when we're delivering back to a client, and it's more a function of where they're starting from and what we're trying to get to, right? So the first 3 months might be a little bit shorter, but then we get there. If you have a full-time team, right, their whole job is to come in and facilitate and close. You want to be driving those dates closer to 10, 12 days. And some will look at business days, which is probably a more fair way to do it, unless you have a really high driving culture where everyone works weekends and does everything all the time because you have holidays and dates off. So you want to build it around that. I would say from in addition to the reports, you want to have a monthly meeting. And it doesn't have to be like a board meeting or a formal, like it's scary. It's just we're going to sit down for 60 minutes, 90 minutes, 2 hours, depending on the size of the team and the organization. And finance is going to present, this is what happened, right? These are some of the areas that we want to discuss or that we've already identified what happened. Here are some areas we're not sure what's going on. We want to make sure that everyone in this room has the chance to figure out what's happening and then collectively make some decisions. And going back to using the financial statements as a managerial tool, like we want to use this information to actually improve the business and tweak 5 basis points here, 20 basis points there, month after month after month. And that's going to compound to where hopefully we're going to beat numbers if sales and other things are working.
Okay.
That's monthly. Weekly, I would say whatever your company KPIs are, your scorecard, your metrics. We just discussed some generic ones, but I would encourage, whatever industry you're in, to spend some more time digging into that. At the executive level, you should have 8, 10, 15 of those, and ideally there should be a name next to each one, so somebody owns each of those numbers. So someone owns leads, someone owns turnover, someone owns these things, and when those numbers are good, we celebrate it, and when they're bad, we talk about it, and then we see if we can improve it and fix it. If it's a trend, right, that's a performance issue. It starts to really help drive the business. So that's at a very high level what I look at. We talked about the 13-week cash flow. I think that's just a standard good thing for younger businesses or growing businesses to be looking at and monitoring. Or if you've lost a key account or something happens and you haven't been doing this, I'd encourage you to get in the cycle of setting that up, or someone on your team setting that up at least once a week. And then beyond that, I would just maybe share too, like these things can evolve. And so the score, like the P&L, the balance sheet, the statement of cash flows, those are fairly standard, but how we structure those accounts, what we show can be changed. So if you're seeing your P&L and it just says sales and operating expenses and profit, that's not very useful. Like we want to break down sales by what? If you have reoccurring sales, if you have one-time projects, if you have special activities, like let's break those down, and then let's have costs of good accounts that allocate to those too, so we can quickly see gross profit for each of those lines right there on the monthly report, and not have to spend another hour digging or asking questions every single week. And that's an evolution. So maybe month 1 it's presented and we go, hey, it would be more efficient or more effective for us to do it this way. Let's say starting next month, we'll make that change. Great. Then the accounting team changes it, and on a go-forward basis from that month on, that's the change. And you do that compounding over years, you're going to have a really tight, useful managerial accounting structure that's working. So yeah, that's what I would look for. And I think, again, industry specific, I know we're trying to stay broad, but there are always specifics to each industry where
right.
Maybe it's not at the executive level, but certainly at the department levels, they need to be detailed into that cost of acquisition, by line, and monitoring that, because it's their job as a department to make sure that that's working.
Great. Well, thank you so much, Brennan. I got dozens more questions, but not that much more time.
It's great to be here.
So I appreciate it. I love talking to you about it. Thanks for taking the time to let me ask those questions and to work through some of this.
Yeah, thanks, Christian. Appreciate it, and appreciate just our friendship and all these things we've been able to do. So you have a phenomenal group of clients, and excited to hopefully give some value here. Hopefully they can use some of these things that we're talking about today.
So you probably picked up that Brennan mentioned that buyers look at these numbers really hard when they're evaluating a company. So if for you an exit is on your horizon, watch this next video. Why 80% of profitable businesses never actually sell.